Thank you very much. Pleasure to be talking with you all, good which particular part of the world you happen to be in today. Let me just say a word about how these ideas came about. As Dr. Jaffrey said in the introduction, I have a background having practiced as a strategy director for many years and taught strategy at London Business School for some time. And the unfortunate truth is that the tools and methods and frameworks that we use for teaching and working on strategy really are not good enough. What I needed to do with my colleagues when I was responsible for strategy was to figure out what to do, when and how much across a whole set of different issues and decisions in the organization, everything from marketing to product development to hiring people to expanding into new geography. And those are continuous questions. They arise all the time, and the answers keep changing depending on what's going on. So the static frameworks that we've used in the strategy field for decades they're really not fit for purpose, and we need better tools. Unfortunately, and what I hope to demonstrate today is that those better tools actually are there, and what's better still is they're not too difficult to use. So I'm going to be talking. Fundamentally, I'm going to be describing how you simulate strategy and performance. Now, in other fields, in other aspects of what we do in the world, we take simulation as normal. We do it all the time. We simulate how drugs are going to work in the body. We simulate how aircraft engines are going to behave. We simulate all kinds of things, particularly when those things are kind of complicated and difficult. It's safer and it's cheaper to simulate than carry out practice on the real world. But that's not what we do in management. But what we do is we carry out uncontrolled experiments on the real world all the time, risking other people's money and other people's livelihoods, which is really not good, not acceptable. And what I want to show you in this session is that many people think that simulation is complicated and difficult and technical. It's not, actually. It's not really difficult at all. And the second pushback I get on this is, well, we do all the stuff that we do already. It's already a lot of work to prepare our business plans and our budgets and monitor performance and so on. I can't afford to spend more work and employ more people to do this simulation stuff. Well, the reality is it is not more work. It substitutes for work you would do anyway. And because it's actually easier, faster, clearer and more engaging than the kind of spreadsheet tools that we normally use for planning and monitoring and managing things, it actually takes less time. It's less work than what we conventionally do. Where we get to with this is that by the time you've built one of these things, what you've got is you have a working, quantified business model. Now, both of those words are really important. The model actually works. It's like a physical model of something. You press the lever and something starts moving. Well, these models start moving in the same kind of way, and they're quantified. We're talking about actual quantities of money, actual numbers of people, actual sales of product, actual numbers of customers. We're not talking in abstract qualitative terms here. As a result, what these models do is they allow you to explain past results. And when we're working with an ongoing existing business, the first thing we do is develop the model so that it does match and explain what has happened up to the present point in time. And from there, you project likely futures. I'm not pretending here that there is only one certain future and it's all completely certain. Of course, there are uncertainties. But this gives you a projection of likely futures under a range of different assumptions. And what that allows is it allows you to develop strategy on the bench, on the desk, if you like, rather than develop it on flip charts with words and arrows. You can bench test the strategy. You can actually run it, see whether it is likely to work. Then, when you've got the thing, you can monitor the business as it actually progresses and develops against what the simulation told you should be happening, and continually adapt and manage the business for anything that changes. Now, this idea of business models is really popular at the moment. It's all over the place. It's talked about in business school courses and endless books, and all the consulting companies tell you that you really ought to understand your business model. After they've told you you ought to understand it, the next thing they tell you is you ought to change it, which is not very often a very good idea, but that's the kind of thing that they do. So everyone is talking about business models. Problem is, we're not really clear what we mean by these things, so let me just give you a couple of examples. Here is a business model framework from one of the leading consulting firms. This is from Boston Consulting Group, and what they say is that you should identify the target segments that you want to serve with your business, define the product or service offering that you're going to provide to those target customers, and figure out what they're prepared to pay, how much they're likely to buy. In other words, the revenue model. Where's the money going to come from here? So what's the value proposition we're offering, and where does the money come from? On the operating side, the cost side of the business, you should work out what your value chain is, what the different activities are and how much they cost, and that puts together a cost model of the business for you and how that's all going to be organized. And then when you glue those two things together, what you get is a business model, which is not untrue, and it may be useful, but there's nothing defined about any of these items here. And here's a guideline from PwC, the large accounting and consulting company, in what they call the back to basics business model. If you go to the PwC website and look for back to basics business model, you'll find this process described there by PwC. And they recommend you should go through the following activities. So you should describe how the company delivers products and services. You should discuss the business model in the context of the overall strategy. You should explain how the business model will make money by making and selling products. You should explore value creation activities. And they actually use this phrase in free-form style. They are not asking or encouraging you to quantify anything or put any scale on anything at all. They're advising you to explore value creation in free-form style. Then look at your value chain and how the company adds value. So there's lots of describing and discussing and explaining and exploring and looking at, but there's no measuring anything, there's no quantifying anything, there's no figuring out how things actually work and function in the business model. Now this is a very popular framework known as the business model canvas. If you go to the link I've provided there, you'll find this, or just Google it, you'll find business model canvas very easily. Businessmodelgeneration.com is the source of this. And they go a little further than the two consulting companies I've just mentioned. So on the right, they say you should define your customer segments. You should to the left of that, you should identify and specify the relationships by which you deal with those customers and the channels through which you reach those customers. To get those customers, you have to have a clear idea of what your value proposition is, and the value proposition comes from the key resources you need to deploy to make the business work and the activities that make the business function. And back up at the supply end of the business, you may have to work with partners, suppliers, other collaborators. So at the bottom, you've kind of got the revenue side of things to the lower right, and you've got the cost structure side of things to the lower left. Now, this is probably a bit abstract. So what I plan to do is, as in all these things, it's very much easier to follow an argument if we do it in the context of an actual story and an actual case. So let me tell you about an actual case right now where the activity I'm describing has actually been used and is in the process of being used right now. And the case concerns a marine engineering business who is planning to make equipment. Well, they already are making equipment to remove organisms from the ballast water in ships. Now, the International Maritime Organization is very worried about this, because what happens is that ships pick up organisms in one location on the globe in their ballast water. They sail to another part of the globe, and then they pump their ballast water out again, and the foreign organisms get put into the sea at the ship's destination, and those organisms don't belong there. So you get alien species being moved around the oceans, which is a bad thing. So right now, as we speak, in the last few days, the International Maritime Organization's members, which is all the countries in the world basically, have got to the point where a large enough proportion of those countries is prepared to support regulations requiring ships to put this equipment in their ballast water holds to clean their water. And what that means is that there are 57,000 odd vessels in the world. All of those vessels are going to have to be fitted with that equipment in the next 5 years. You have to fit the equipment the next time the ship comes in for maintenance. And then, of course, every new ship that gets built will have to have this equipment installed as well. The challenge for this company that we're discussing is how to capture the ship operator's choice of which system. As I see on this, as you can see on this slide, there are over 35 approved systems from 50 suppliers. They are not all going to survive. There is going to be a big shakeout of companies whose systems don't get adopted and don't get used. So this company has to capture ship operators' choice of the equipment system that they're going to use as fast as possible. And when they've captured the ship operator, they've then got to get the equipment installed rapidly in all of the operators' fleet. So if you win the contract for a ship operator with 100 vessels, then what you want is you want to get your equipment installed in those 100 vessels as soon as you possibly can. So that's the business. It turns out that its business model is actually quite complex for what looks like a rather simple business. To start with, there are many different customer segments, and the segment that this company is best suited to serving is mid-sized ship operators who are operating mid-sized vessels. So not little fishing vessels, that kind of thing, and not the huge container vessels or crude oil carriers, the kind of vessels in the mid-size. And they also have to sell to the designers of those vessels. The problem is there are multiple classes of vessels. Ferries are different from oil field support vessels, are different from cargo vessels. Now, this is a small company, and they're not going to reach all of those customers in those segments directly themselves, so they're going to have to work through agents. There'll be some direct sales, but they'll have to work through agents. They haven't got big staff resources, so they're going to rely on third-party installers, and they're going to distribute spares through those same through distributors. Channels, well, they're going to go through the agents, they're going to go through shipyards and installers. Their value proposition is that this equipment must be compact and easy to fit, it must be really simple to operate, and it must use low consumables. Some of the competing technologies use basically chlorine, the same thing you use for cleaning a swimming pool. Well, this company's product does not. It's a raw material free piece of equipment. The resources they have, well, they've got the different models of equipment that they produce, they've got the agents they have relationships with, their sales force, their customers, their installers, and the installed base of equipment is an asset as well. It's a resource because that drives maintenance and spares revenue. Key activities, they've got a lot of different things to do. They've got to develop new models, they've got to get them approved by the Maritime Organization, they've got to win agents, they've got to build market awareness, acquire customers, capture orders, get the units manufactured, get the units installed, arrange spares and maintenance delivery. So for a small business, and currently it is small, this is quite a lot of different things that they have to handle, and they have key partners. They're working with the Research Institute to develop the new technology. They've got relationships with equipment manufacturers to make the thing and equipment installers. The cost structure, well, there's R&D costs, manufacturing costs, cost of goods, obviously. You buy raw materials to make these things. Staff costs come from the sales force and the engineers. There's installation, which is an outsourced cost. You outsource that to someone else, and there are spares distribution costs. Revenue comes from supplying the equipment, and it comes from spares and maintenance. So this is a pretty rich business model for this organization, and it described pretty well what's going on, but it's actually of pretty limited use for developing exactly what your strategy is going to be. Why do I say that it's limited? Well, here's some of the problems. The terms that we use here are very ambiguous. People use the term resources indiscriminately, channels indiscriminately, partners means all kinds of things, customer relationships means different things. We're very ambiguous and qualitative about what we mean by words. There's no idea at all about scale here. We've no idea if we're talking about 10 potential customers or 10 million, 5 products or 50 or 5,000. No idea whether the price of this thing is $50 or $5 million. There's no scale on any of these items. Crucially, we have no idea from this picture whether the business model will actually work. When we start to do this, will we actually get any sales? Will we actually generate any revenue? Will we incur costs which are less than that revenue so that we actually end up making a profit? There's no guidance on from this or any other business model framework as to whether the thing will work. There's no way of testing it. We can't test uncertainties. We can't test, for example, the uncertainty, the consequences of some delay that might arise from the maritime organization delaying their decision to authorize this change to the industry. You can't test strategic choices here. Should we have 2 models or 5 models or 20 models? Should we go for the one particular sector of the shipping industry, or 3 sectors, or 10 sectors? We've got no way of testing those things. And so, most unfortunately, we can't tell anything about the future performance of the business from this. We've got no idea what sales will be, we've no idea what cash flow outcomes will arise, we've no idea what investment we've got to make. And of course, it's not just management who wants to know the answers to those questions. Investors want to know the answers to these questions as well. And the reason we built this model in the first place for this company was because the CEO had to go to the board and make a case for investment. Well, how do you do that if you haven't got any numbers on anything? So let's see if we can fix this by building one of these working business models. Now, this is a screenshot of the, if you like, the control panel for this particular company. And the issue that the board were very interested in is down in the lower right of that diagram. And you can see a little scale on the bottom. It goes from 1 to 60. And we've actually got to month 21. So this is a 5-year plan for the business, and we're at month 21. You might just be able to make out a dashed line lying behind the solid line on that cash chart, and that dashed line is the company's actual results up to month 21. To the left of that is the company's income statement, and again we've got dashed lines with the company's actual numbers on, and the solid lines are what the simulation is telling you the performance should have been. So when we build these models, the first thing we're trying to do is explain what has actually happened, and we've got a pretty reasonable match so far as to what's actually happened. We've got the simulation generating about the right amount of revenue, about the right amount of margin, about the right amount of EBITDA profit, earnings before interest, tax, depreciation. So that's all looking good. Now, where does all that come from? Well, in the top line, you've got and the top left, you've got the different models of equipment that the company offers. It's a small company. It's not going to offer a huge range of equipment. And right now, it's just launched the second item. So it's got one particular piece of equipment that's suited for a particular kind of vessel, a certain size of vessel, and it's just developed a second model which is slightly larger to be suitable for slightly larger vessels. The little red lines there, that's simply showing the periods when the next model is in the process of being approved by the authorities. So you've got a model which is in approval just before month 21, and when you get to about, I think it's about month 20, that model finishes the approval process and it becomes model number 2 in the company's range. Next to that, you've got the ship operators, and the red line here is the actual customers. The blue line is prospects that the company is talking to. So the blue line is not generating any sales yet, but if those companies can be converted to become real customers, then the red line will grow. And if the red line grows, then the next thing will happen, which is the sales of units. So this is unit sales per month as the business moves forward. So you can see there's likely to be a bit of a step when you get out to month, I think it's about month 36 there, where the company introduces, I think that's about the third or fourth model in the series, and what that does is it opens up another customer segment, so your sales rate jumps. And then the final thing on the top there is the installed base of equipment, and the installed base generates revenue. So, as I say, this is just the control panel. What's the actual model look like? Now you can actually go and look at this model yourself on any browser. Just go to the link shown here, sdl.re/bwts. You can go and play this model yourself. It's disguised for confidentiality reasons, but basically it's reflecting what's happening in this company. So here is one little piece of the model, and the way to think about this is each object in that purple square, think of that as a column in a spreadsheet with the name of the object at the top of the column, and as you go down the column you've got all the time periods, so you've got 60 rows going down beneath the column in the spreadsheet. So this is a kind of visual spreadsheet, if you like. And each element here contains a simple formula. So that formula there is maximum projects per month equals the number of service engineers you have multiplied by the maximum number of projects per month each engineer can handle. Now that actually is the formula. It's not $22 multiplied by worksheet 3 $38. That is what you actually see when you look at the working model. So it's much more transparent, much easier to understand. At the top, we capture the interdependencies. So that little circle in the middle at the top there is the number of projects delivered each month. So the projects delivered is the maximum possible if there are any in progress. So how many can the engineers install? Are there any projects waiting to be installed? If so, they get installed and they move from the top left box into the top right box. And we deal with accumulation, so we are accumulating the installed base of vessels there. Now, we don't have to do a whole business model, and it's quite a substantial task to take on. As I said, it's not actually difficult, it's actually easier than doing it with spreadsheet tools. But even so, you may find it easier to start with something more limited. So this diagram shows the part of the model that's about winning prospects. So prospects are flowing in from the left to that first box there, the customer prospect stock, and then further sales effort coming in from the top is pushing those prospects through to become actual ship operator customers, and then from that you get the sales in the pale blue area at the bottom. So this alone is a powerful model. In fact, this is where we started with the CEO. We did this on a couple of Skype calls. We built this part of the model so we could understand at what rate the company might win prospects, at what rate they may actually sign up ship operator customers, and at what rate actual sales of units would come from those customers. So as I say, you don't have to do the whole business if your principal interest is about one particular aspect of it. This is a sales part of the thing. You might have other issues where you're wanting to look at what's happening to staffing or what's happening to product development or service quality. Sub-models about parts of the business are perfectly useful on their own. As it happens, in this case, we went rather further and we built the whole business model for this business. So let me, this is going to be a little bit scary, but I'll take you through it a piece at a time. This is the whole of the model, and I've just shown you the right-hand part of the purple section at the bottom there, which is how engineers take equipment and install it in customer vessels. I've also shown you the sales part, which is the blue part and the pale blue part that I've highlighted with those two red squares. So let's just go through the structure of the whole thing. And up at the top, you've got R&D spending, which adds equipment models to reach new customer segments. It's quite small to see, but the right-hand box in that yellow section is the accumulating number of different models that the company is developing and offering to its customers. The green block in the middle is the growth of the sales force, and the various circles below that take that sales force and they allocate the sales force time to the various different things that they could do. So do I send my salespeople to call on agents? Do I send my salespeople to call on new prospects? Do I send my salespeople to go and call on warm prospects that might have been won by agents and try and sign them up as actual contracted customers? Do I send my salespeople, the very bottom item in that green section there is about sending the salespeople to call on customers we already have to agree with them when the next units are going to be installed in their vessels. So that's actually closing sales, that piece there. And you've got agents in the grey area bringing customer leads, and agents and our own sales effort turn those into real customers and real sales. When you've got customers, every time you sign up a customer, they bring with them access to their fleet. So the left-hand box in the purple area is not vessels that we're already working on. These are vessels that customers have got, but we have not yet started the process of selling or installing the equipment into them. So you've got a pipeline there of vessels in different states. So the first state is I have access to these vessels, but I haven't sold it. The next box is I have sold the project to install the equipment in these vessels. The next stock is I'm actually building the equipment for those vessels, and the final stock there, the fourth one along that pipeline, is these are vessels that have actually got our equipment in them. They're on the seas, they're sailing around, they're doing their job, and our equipment is in those vessels and cleaning its water for it. The other two boxes to the lower part of that purple section are the engineers. You've got one group of engineers who do the design work and manage the manufacturing part of the process, and you've got a different group of engineers on the right, which I showed you a couple of slides ago, that actually do the installation work. So that's what I've just said. Sales trigger production projects and installations are managed by engineers. So installations drive revenue, staff drive costs. If you take the cost of manufacture away from revenue, that gives you your gross profit. You take staff costs away from gross profit, that gives you your operating profit. Most other things are outsourced, and you've got to pay those outsourced costs, of course. But the pale yellow area, I won't go into the detail of what's in there, but it's basically the income statement. You've got revenue at the top, gross profit in the middle, costs towards the lower end, and the actual amount of cash we've got is over to the right. Now, of course, there's competition here. As I said, there are 35 other systems and 50 other suppliers here. So the little red box there is looking at the particular aspect of competition, which is to do with price. We're assuming that our equipment is fit for purpose and it does what it should do. But other people's equipment is also fit for purpose and will do what it should do. So price will be a critical question, determining whether we actually manage to sign up customers, and if we do they give us the agreement for the vessels to be installed. Now, not all of the links are shown here, but in reality there is a link going from that price area across to the sales area over on the left, and up at the top right, that's just the summary control panel we had. So you can think of this as very like the control panel for a factory, or a control panel for a rail network, or a control panel for an oil refinery. It's got everything on it that makes up the real business. It's got all the decisions on it, like price and hiring and launching new models and spending on R&D. You've got the decisions on it, the decision levers, and you've got a picture of how the whole thing works. So what you have here is you have a living business model, and that living business model can be used repeatedly to plan the future and to gain investment. Now, this is a relatively new initiative that we're taking, and the underlying method that we're talking about here is something called system dynamics. It's been around since the 1960s. It's extremely powerful, and it deals with how the real world behaves in ways that our kind of standard methods just can't do. But the way in which the methods often used is used to create a model which says, okay, here's our issue, here's what we want to understand, here's what we're going to plan. Oh, there's the answer, thank you, we'll put the model away until the next issue comes up, and then we build another model and try to deal with that. Well, we're trying to do something much more useful with this particular one. We're starting on this phase right now, and that is that this is going to be the continual management, control and update model for the business. This is going to be what the CEO and the management team actually use week in, week out, month in, month out. And to do that, what you do is that you put in the actual data alongside what the simulation is saying every month. So every month that goes by, you put in how many items of equipment have we got, how many salespeople do we have, how many customers have we got, how many customers did we win last month, how much revenue did we generate, how many units did we install, how much cash did we make, how much cash did we spend, what's our cash balance. You've got the whole thing. This is joined up strategy. It is an integrated, functioning, working model that you can continually update. Now, when you do that, what you will find for certain is that things do not work out as you hoped that they would. Things will be different. Competitors will react. Customers will make decisions you didn't expect. You will succeed in selling into a big customer that you didn't expect and get a big jump in the number of potential units you could sell, or alternatively you could be disappointed and one of the prospects you hoped you would get doesn't work out. What that means is that the model will have to adapt, but its fundamental structure will remain the same. It's just that the relationships, the formulae, the equations, if you like, in the model will have to be adapted. Now, when I show these kinds of things to people for the first time, they usually get very, very scared and say, oh, God, dear, that's really, really difficult. But what I do is ask them about the spreadsheet models that they usually use to manage their business, and a place to start is, well, how big is the biggest spreadsheet that you have? How many lines has it got? How many columns has it got? And they usually conclude by telling me, first of all, they've got lots of different spreadsheets doing lots of different things for different parts of the model, of the business. And then they tell me that these spreadsheets have got hundreds of lines in, and they've got many pages to them. Okay, so people are perfectly comfortable working with spreadsheet models that have got hundreds of items in them. But this picture that we have here is the complete business, and it's got no more than 100 items in total, probably rather less actually. So this model is more compact but more complete, and it's integrated compared with what you would otherwise expect to find in a company. I could say a little bit more about that issue of spreadsheet models and the problems and challenges that they produce during the Q&A part of this presentation in just a moment. So this is what I really want to end up by summarizing for everybody on this call. Simulating strategy is not difficult. It's not easy, it's not trivial, but it's certainly not difficult. It's not beyond the capability of any decent analyst to do this, right? You do have to follow some pretty important procedures and disciplines to make sure that you build the model correctly, that you test it correctly, that the numbers all do what they're supposed to do. But fundamentally, it's no more difficult than making sure that your spreadsheet model is valid and hasn't got any mistakes in it. And when you've done that, what you get is a working, quantified business model. It actually works. It does what the real world does, and it does it for the same reasons. And you can be pretty confident that this is good because the underlying theory is rock solid. It's the background to this is that the method was developed by Professor Jay Forrester at MIT in the United States in the 1960s, and he's a control engineer. He developed guidance systems for radar and things of that kind. He's an engineer, and what he did was he took engineering control theory and said, a business is a designed system. Just like a car is a designed system, or a ship is a designed system, or a factory is a designed system, a business is a designed system. Therefore, we should use the principles of engineering control theory and engineering control management to design and manage the business, the enterprise. So given that, what these models do is they explain past results. And a model that can't explain past results definitely needs to be reviewed and taken apart and figure out why it didn't properly explain past results. And when you've cleared that hurdle, then you're in a position where you can project likely futures. And with that done, you can develop the strategy, you can test the strategy, you can monitor it and manage it. And fundamentally, where we are today, making judgmental decisions and qualitative decisions about what we should do is not acceptable in any other profession. Why do we think it's acceptable in management? Every business should have a working model of how it works, and every analyst who advises management should be able to do it. And it's not a too demanding thing to try to do. Now, if you want to find out more about this, the principles of how it works are in a book you can get. There's a Kindle book or a printed book you can get called Strategy Dynamics Essentials from Amazon. And the model I showed you screenshots from is built in one of the tools for this purpose. I should declare an interest. One of these tools is one that I actually have an ownership in. But to be even-handed about this, there are several tools that do the same thing. They all have their strengths and weaknesses, and I'll leave you to investigate which of those you think might be most useful for you. I won't list them right now. So I see I've got just a few minutes. Actually, have I got a few minutes left? No, I don't. If I have a few minutes during the question and answer session, I may just switch over and demonstrate the working model to you. But I think now is probably a good time to stop the presentation itself and just ask if there are questions coming in. So back over to Dr. Jaffrey.
Thank you very much. Folks, we are now open for question and answers. If you have any questions, you could either put it in the question box or you could raise your hand. There's a hand icon available on the webinar console, so if you click on it, you'll be able to speak directly to Mr. Warren. So let me go straight to the question box. We have a couple of questions already posted. Could you please tell us what companies are doing this strategy simulation?
Yeah, sure. The first thing to mention is that this is a leading edge activity. There are not many companies doing it, but it is beginning to become popular, and some of the leading companies are starting to do it quite seriously. So I can mention, for example, that Coca-Cola uses this method for modeling and planning its global brand strategy. Now, that might seem a relatively simple task to undertake, because you've just got Coca-Cola and you've got lots of people who want to drink it. But it turns out it's not that simple at all. There are many different kinds of product that Coca-Cola sells. It wins or loses those customers to lots of different brands from lots of other different companies. It has to sell those its products through distributors and through retailers and through those lovely red machines we see all over the airports and sports centres. So it turns out to be quite a complicated thing to do, and the way in which each different geographic market behaves is rather different. So that's what Coca-Cola does with it. I can mention a large construction company, a global contracting company called Fluor. Companies like Brown and Root and so on. It's one of those kinds of firms. They build big things, really, really big things. Oil refineries and sports stadiums and almost new cities. They are a big contracting firm. And the problem for firms like that is that the projects themselves are really complicated. There's an awful lot going on in a major project of that kind. So Fluor builds these models of their projects, and they build them with the client. I guess most people on this call will be completely familiar with the idea that construction projects very often go wrong in some kind of way. They take too long, they cost too much, and they don't meet the specification originally agreed with the client. And sometimes we end up with very serious disputes between clients and contractors. So Fluor tries to avoid that by building the model of how the project is supposed to work with the client. And then as the project goes on month by month, quarter by quarter, they update the information on how the project is going. And one of the most important things that does is that when the client says, I've changed my mind about this particular part of the project, I'd like it to be built like this rather than as I originally said, they can both sit down with the simulation and say, well, this is how the project was supposed to work. If we make these changes, how will the project work now? So you get the client and the contractor kind of on the same side. Another industry where the method is getting increasingly used is in pharmaceuticals. It's particularly to do with the very complicated issues of product development, how products go through the R&D process, how they get tested and approved, but also how to manage the life cycle of a pharmaceutical product. You'll know, of course, that there's usually a patent protection on a drug, and there is a very important strategic issue about how much effort to put into marketing and selling a drug through its life cycle, and when it's coming towards the point where its patent is going to expire and lots of people will come in with cheap copies of the same drug, what should you do about your price? What should you do about your marketing? Where should you deploy your sales force? The company concerned will nearly always have a next generation product which has a new patent life associated with it. So how does it allocate its efforts between the existing company, the existing drug, and the follow-on product? One last context that I might mention is, and the example I gave you is one such example. It's increasingly used for new businesses when you're trying to evaluate how a new business should work, and explain to investors what exactly it is that they're investing in and how the business should work given the millions of dollars that you're asking them to fund you with. Then actually simulating the new venture is extremely powerful, and a friend of mine is running developing a new business right now, and he's been through 2 rounds of fundraising to raise nearly £2 million for investment funds for his business, each time sharing the model with the investors so they can see what they're getting into.
Thank you very much. We have another caller who has raised a hand, so let me go see if we have Midu Dha. Could you please introduce yourself and ask a question?
Thank you for the very nice presentation and very nice system simulation. I have one. My name is Moyed Aldaman. My short name is Midu. My question is, hello, can you hear me?
Yes, I can. Yeah.
Yeah. My question is, what is the difference between this simulating strategy and, if you know, IDEF0 or the function model? I think it is similar. This is like a workflow or process chart, isn't it?
Yeah. That's a very good observation. We use one of the things that we do use simulation for. We've used it for decades. Is for simulating things like supply chain, like workflow, and in fact, the technology behind this that I've been describing today is already used for supply chain management and for workflow modeling. There is a small difference, though, which is just worth mentioning. It's important to be aware of this difference. For workflow modeling, it's more common to use a slightly different simulation method known as discrete event simulation, where you're actually tracking individual units moving through the workflow, or in a supply chain case, you're actually looking at how units of inventory move from one particular stock to the next. So that's discrete event simulation, and it's very closely related to system dynamics simulation, and the two methods are slightly better suited for slightly different cases. So when you do want to track what's happening to individual units, then discrete event simulation is definitely your tool of choice. The kinds of case where system dynamics modeling is more useful is where you're not so concerned with the fate of every individual. You're more concerned with what's happening to the broad population of things. And in particular, when you've got lots of different interrelated things. So, in the case I explain to you, you've got customers, you've got staff, you've got vessels, you've got products, and you want to model all of those things, and you want to model them at a reasonably high degree of aggregation. So that's what system dynamics is better suited for. It's been around for a long time, as I say, and I think the reason many people may not have heard about it is that it seemed quite technical and it seemed quite difficult up till now. But the software tools I just put up on the final slide there, they all make it much more easy to do these days than it was before. So I hope that's answered your question.
Yes, thank you a lot. I think they have more similarity, and I think simulating strategy, what you have presented to us, is more integrated, let's say.
Mm-hmm.
Thank you a lot.
You're welcome. Right, nice talking to you.
Thank you very much, Mr. Mahid, for the question. Now, let me move to the question box. We have one from Brother Abdul Salam. It's rather a comment. He's asking, I think models building needs psychological understanding of human beings, deep understanding of the reality, knowing the past and looking at the future, and all of this should be based on sustainable development and way of thinking. Any comments?
Mm-hmm. Yeah, well, there's two very good points in that question. The first is the importance of understanding human behavior. Now, you may have worked out that in the model I showed you, there are some aspects of human behavior that already need to be captured, and one of those is a customer going to agree to buy my equipment or not? And if they do, are they going to sign up for placing orders with me? So when it comes to customer behavior, what we put into the model is we put into the model exactly the understanding of customer behavior that we would get from our marketing tools and methods. There's a particular marketing tool, for example, called conjoint analysis. It's well worth having looking this up on the web and finding out a bit more about it. Conjoint analysis. And what conjoint analysis does is it allows you to research how customers trade off different features and benefits in a product or a service. So in this case, we've got a product that has a certain ease of use, a certain cost of operation, it's got a certain price, it's got a certain reliability. So if I'm a customer, how do I weigh up and balance those things when I'm making the decision to agree to use your equipment and not your competitors? Well, conjoint analysis is the marketing tool for that purpose. Now, I've done quite a lot of work in staffing related issues, organizational change, gaining adoption of new cultures and that kind of thing. And there again, one of my collaborators is a leading expert in the psychology of leadership and team behavior. And we do the same there. We don't invent new theory about how these things work in the process of building the models. We take theory which is already well understood, principles that are already well understood, and we put those into the model. And if we need to go and talk to an expert in those fields, then that's what we do. These simulations, what they try to do is they try to assemble and join up things we already understand, not make big bold assumptions from first principles about things that other people have already thought about deeply. Now, there was a second part to the question. I think your question asked about sustainability. Now, there's a big initiative, a global initiative being led by many of the large reporting regulators and the large accounting firms around the world, called the Integrated Reporting Initiative. And this is an attempt to do two things. The first thing it tries to do is to give investors a much, much better understanding of how a business is performing and what its prospects are likely to be. But the second part of it, and this is a really important thing, is that the integrated reporting framework requires firms to report on their social and environmental impact, both in terms of the social and environmental things that they consume, so how many people do we need, and how much raw material do we need, and where does that raw material come from, but also the stuff that you put out. So what kind of impact you have on raising skill levels in the localities where you work, for example. What do you do in terms of paying people, and what does that do to the local economy? Obviously, there are issues of sustainability about waste and carbon emissions and that kind of thing. So the integrated reporting framework requires those as well. Now, if you're going to report on those things, you need a working model that tells you how your business operations affect those social and environmental outputs. Well, guess what? That's what we've got. We can very easily incorporate social and environmental impacts in these models. In fact, I've got a case where we've actually done that.
Well, thank you very much. That really brings us towards the end of the webinar. I really want to thank you, Mr. Warren, for your valuable time. Any concluding remarks that you want to give before we dismiss out?
I simply like to go back to the conclusions on this last slide here. This is what we should now be doing. We should not be operating business strategy on the basis of checklists and 2x2 boxes with arrows on them. We should be figuring out how the business actually functions and building models that mimic, they copy the actual behavior of the enterprise that we're trying to understand. It's not difficult these days. It's very possible to do it, and it should be widely used. Whether you use my tools and my methods or somebody else's, it'd be nice to use mine, but frankly, it's more important that you use something that does this. If you decide to go with discrete event simulation or agent-based modeling, other tools that are here, that's fine by me, but definitely start thinking about whether your business performance could be substantially improved, and the management of the business could be way easier if you adopted some of these ideas in your planning and management of the business.
Well, once again, I really want to thank you on behalf of the Madinah Institute for Leadership and Entrepreneurship, MILE. Thank you very much, Mr. Kim Warren, for an excellent presentation. Thank you all of those who participated in this webinar. We are recording this webinar, which will be uploaded on MILE community, so please stay tuned to webinar.mile.org to learn more about our upcoming programs and equally to access the recorded versions. With that note, we would like to conclude this session, so you all will be automatically dismissed out. Thank you very much. You all have a good day.